Back in December 2021, you warned investors to brace themselves for a potential correction in the tech sector, especially during the first 3 months of 2022. Looking back, the last 3 months now, your prediction for the market turned out to be very accurate. What about now? How do you see the US stock market going forward, especially for the tech sector?
Since that time, there's obviously been new contours to the market that have emerged. And I would largely say that we're still cautious, still want to have exposure. We talked about some of our holdings here, but we're still cautious and still in our portfolio still have a large amount that's in cash. And the reason is that the market has developed a sense over the past couple years, this belief to buy in the pullback. And that works, and we've seen some rallies around that. But ultimately, there's some cleansing that we believe needs to happen with the market, whether it is around still getting better clarity around what the pitch and the speed of rate hikes, what the Fed is going to do around the balance sheet. These are all well known, but I don't think that they're priced in. There's obviously geopolitical risk, what's going on in Eastern Europe, and then you have what potentially could happen with China and Taiwan. And then you have a recession conversation that kind of pulls through this. And so the two camps, basically, one camp is everything I just said is well known, and the market is a discounting mechanism, and the market has factored that in. That's one side would say to be more optimistic right now. Our opinion is that they're just simply not fully priced in. And where do we get that perspective? Is that when we look at our kind of our hit list of companies, there's about 50 companies that we track closely. And when we do our valuation exercise within these companies, even though some of them, many have come down 30, 40, 50%, we still feel that they're overvalued relative to historical measures and what the likelihood that they're going to grow at a pace to reward investors. And so that is, it's less about a feeling and an emotion around the market. We recognize all those macro contours, but for us, it's more just as we go and look at what we describe as fair value, many of these companies are still overvalued. And so if I was going to put it all together, Charles, I would say that I think we're probably going to reach a bottom over the next 3 to 6 months. And when things start, the numbers start getting bad, let's assume that there's going to be some sort of slowdown in the global economy, some forms of recession. Of course, by the time the numbers are bad, the market has probably at that point established a bottom. So, and maybe to bring it to its fullest level here, its highest level is we're still optimistic about owning these. We don't think we're at the bottom. We think there'll be a bottom put in the market sometime this year and the next 3 to 6 months, and then are very optimistic about the market next year. Even though the economies and global growth may slow in 23, I think the markets are going to have a phenomenal year in 2023.
Yeah, that's good to hear. You just mentioned that you are keeping a lot of cash. Just out of curiosity, when you talk about enough cash, what kind of percentage are you talking about from your portfolio?
I can say this, it's at this point, it's greater than 50%.
Wow.
And I think a typical asset manager, if they're heavy in cash, they're maybe 5 or 10% in cash. And so we have a pretty cautious view. Now that it's probably important to note is that percentage in cash has declined over the past month. If you look at when we were talking in December, we were almost 70% in cash.
Wow.
And so we have actually deployed some over the last month, 2 months.
Sure.
However, we are still largely in cash.
Okay. So if you have a 50% of the asset as a cash, you look forward to the next crash then.
The simple, I guess, from rewarding our investors, yes, we think that we don't look forward to it, of course, but our expectation is that there's more downside to the market, and we tell our investors, like, we may be wrong on this. This may be all priced in. In that case, don't put your money with us. But if you want a more conservative approach to what's going on in the markets, we want to manage those assets, and we do, by the way, if the market just keeps going up, we do have a mechanism to recognize that we just missed it. And I think that's an important piece of investing too, is to have a strong view, an educated view, a thoughtful view, but still recognize, as we describe it, as that other person, and we'll call it the view that the market is going to go up, that they have a card that says they are right, and ultimately they could eventually really show that we're going to be wrong, and so we recognize that opportunity.
Sure. Well said. Thank you, Jin. You talked about you still feel like some of the tech stocks are overvalued. And one of the example I can find is Apple. I can see PER at the moment is around 29 times. Considering the historically, the Apple was traded at about 25 times or 26 times. So talking about Apple, about months ago, you appeared on CNBC News and said Apple shares are headed to $250 per share. Unfortunately, for the last month, the situation around Apple gotten worse. For example, China has implemented strong lockdown to fight with the COVID virus, and the war in Ukraine is still going on. Consequently, it was reported that Apple was cutting the production for iPhone SE and even AirPod. So was there any change with your outlook for Apple's future due to these current challenges?
So I think that you need to put some separation between the near and the long term. And on the near term, there is some concern about some of the production shutdowns in Shanghai, and also some of the cuts in production for iPhone SE. And think of those individually. On the production shutdowns related to the pandemic in China, we track the lead times on Apple products, and these lead times are showing the best availability that we've seen before last fall. So despite these shutdowns, we continue to see Apple products are widely available today, better than they've been over the past few months. And separately is the reports about production cuts for iPhone SE. This is something that is a common dynamic around any new product cycle for Apple, especially with iPhones, is they tell their supply chain before to expect to build a certain number. They always tell the supply chain to build a greater number than they actually think, just to prepare for the outsized opportunity that the demand really spikes. And so usually a few weeks into a new cycle, you'll hear about cuts to production. That is a well-traveled road. It is not cutting to their true estimates or to Wall Street's estimates. Essentially, it's just backing off an estimate that they had given their supply chain. So near term, I think things are doing well. I do have some keeping a close watch on the component environment and how that potentially could play out on Apple and across the board. That's a near-term piece to factor in. But I think when you put this together, their business continues to do exceptionally well. And to kind of play it forward is, if I can, what are we concerned about? I think this concern about Taiwan has been nagging at me. I have recently published a piece about what keeps Tim Cook up at night related to Taiwan. And, the dynamic is for your listeners is a well-known dynamic. I think for a lot of U.S. investors, they're just not that educated on how that strategic ambiguity between those if I can call we'll call Taiwan a country for the sake of my to make my point between those two. That strategic ambiguity, I think, could have an impact on Apple, and specifically the fact that they have their advanced chips built there. Of course, that would have a big impact if something happened there on the globe, with 90% of the globe's advanced chips being manufactured in Taiwan. So that piece is that's not going to go away anytime soon. But that is something that keeps me up at night, being optimistic about Apple.
So I talked about the valuation as well. So in your opinion, the valuation side, Apple is still okay, attractive.
So yeah, on the valuation piece, that's I think Katie Huberty recently lowered her price target on Apple because of a lower multiple. I'm in a case that despite all these negatives I talked about with the market, I think Apple's multiple can actually go up. And I think one of the reasons is that the need for their products, they're really the only company when we think of a hybrid work and learn environment, they really are the only company that can deliver something to a consumer that a consumer can use. I think that they will get progressively more into selling their hardware as a subscription, which is good for the multiple. This has been reported by Bloomberg recently. It's something that we've talked about for a couple of years. We refer to it as the 360 bundle. Basically, you pay Apple one fee. It's not in the market today. We believe that they're testing it, and as more of their revenue, hardware revenue shifts to subscription, that should be positive for the multiple. And the last piece is that we think innovation is alive at Apple. And there are a couple product categories, whether it's the metaverse or auto, that they potentially could get into. And if they strike one of those two, if they actually get some products out there, I think the market will, especially with auto, I mean, that is a massive opportunity. It could be big. And to put it into perspective, how big is big? Caution, red lights flashing here is, I've been wrong on them getting into new product categories before. So I'm just going to hypothesize that they get into the car market. But this is such a big market that it could, in the next 5-10 years, be a bigger business than could effectively double Apple's overall business. I mean, they can do $300 billion in revenue in the car business 10 years from now. That is probably Tesla will be more than that in 10 years. And so I think that there's an opportunity there that justifies an increase in Apple's multiple over time. And the 250, how do we get there? We're at for next year, we're at $7.80. I think the street's at $6.70, and you put a 32 multiple on that, and you get to 250. So it's our opinion of how this plays out.
Sure. You talked about the car business. So apparently you believe in Apple Car then.
Well, I believe that they're working on it. I think this has been, I believe the reporting on there. I don't know anything firsthand. I do believe the reporting that's been there. I think Gurman from Bloomberg does an outstanding job in covering Apple. He's written a lot about this. So they're working on it. And then the question is does working on it mean that it ultimately sees the light of day? And I think, if you were going to ask me, make up your mind, is the product going to launch or not launch? You have to make a decision, Gene. What would you say? I think it's going to launch. I think they will get there. Part of the reason why is they need to. And when you obviously have numbers that are as big as Apple's numbers, you have to look forward to large markets. And it is such a juicy market, the auto market. Traditional automakers are dysfunctional. And I think that that has created this an open opportunity, not only for Tesla, but for other tech companies to get in there and really reimagine transportation. And so I hope they get there. My guess is they get there, but I'm not willing to put a stake in the ground and say that they absolutely will be there.
I hope so too. And talking about the Apple's future, you sometimes talked about the opportunity in metaverse. I mean, usually when people talk about metaverse, they talk about Facebook or Unity software, Roblox. How do you approach the Apple? How do you connect Apple together with a metaverse? What kind of aspect are you seeing from there?
So there's first, the metaverse is yet to be defined. Meta, the company, Facebook, has a vision of it really being immersive, AR, kind of a wearables kind of a future. Think of this as maybe a riff on Ready Player One type of experience where you're wearing a headset for multiple hours a day. That's at kind of one end of it. The other end is just a little bit of an evolution from the current internet, from the current web that we know. A 2D environment that just has more engagement in content. the way we think about it is that you need to basically be positioned for both of them to happen. We don't know which one's going to happen, but be positioned for both of them. And so on the 2D side, one piece that we're invested in is gaming. We own Take-Two. We own at a smaller and a more measurable level. We own Take-Two. We own other gaming companies at a smaller level. We do not own Roblox right now, but those all are Roblox in our view is still relatively new, and the teen market is pretty finicky and can kind of come and go. But Take-Two, Grand Theft Auto is just an iconic title, and it is the first step in monetization of a 2D metaverse, and could be monetized in a 3D, an immersive one too. So that's kind of one approach to it. And then the second approach is you can own something like Apple, because they'll probably are going to have some form of a metaverse wearable. Interestingly, as it stands today, Apple doesn't use the phrase metaverse very often. They don't like that. I think it's partially because how competitive they are with Facebook, but also it and just kind of acknowledgement of Facebook and what they've put the stake in the ground around. But I think they just really see this as just kind of the next computing platform. So that's one way to do it. And then another way, kind of at the other extreme, would be to own something like Meta, aka Facebook, and because there's obviously a hardware component as well as a platform component to that.
Yes.
So that's how we think about investing in the metaverse.
Excellent. Thank you. Thank you so much for your insights on Apple. Can we move on to Tesla now?